$44 trillion. That is the amount of foreign capital currently parked in US dollar denominated assets right now, and the only thing holding it there is faith, not yield, not fundamentals, faith. And this week, something happened that should shake that faith to its core. And if you own gold or silver, the next 17 minutes could fundamentally change how you see what is happening in these markets right now. If this is your first time here, this channel exists because someone needs to cut through the noise and show you what the data actually says, not what the headlines say, not what the talking heads on financial television want you to believe, what the numbers prove. Subscribe right now and turn on the notification bell because the information I am about to share with you is not showing up on any mainstream financial channel. Now, here is what everybody is focused on. Silver down more than 44% from its all-time high of $121.67 set on January 29th. Gold pulling back to around $4,500 an ounce. And you are seeing the same recycled headline everywhere. Metals crash. Safe haven status questioned. Is the gold bull market over? And I need you to tune all of that out because the crash in precious metals is not the story. The crash in precious metals is the distraction from the story. And the story is what I discovered when I started pulling the data on the bond market, the financial sector, and the Federal Reserve's own projections from this week. Stay with me because what is happening underneath the surface right now is going to completely reframe how you understand this pullback. Let us start with what the Fed actually said on March 18th. They held interest rates steady at 3.5 to 3.75%. No surprise there. But here is what matters. Their updated dot plot now shows only one rate cut projected for all of 2026. 7 of 19 Fed officials think there should be 0 cuts this year. 0. And they raised their inflation projection to 2.7% for the year. Now think about what that means. The very people who control the money supply are telling you that inflation is not going away. And on top of that, producer prices came in at 0.7% month over month. That is more than double what economists expected. Double. So the Fed is stuck. They cannot cut because inflation is running hot. They cannot raise because the economy and the labor market are weakening. Jerome Powell himself admitted this week that job creation in the United States has slowed to essentially 0. Let me say that again. The chairman of the Federal Reserve just told you that the American economy has stopped creating jobs, and yet he cannot cut interest rates because inflation is too high. This is the definition of a trap. Now here is where it gets really interesting, and I need you to pay close attention. Look at what is happening in the bond market. The 10-year Treasury yield jumped to 4.39%. The 30-year bond yield is knocking on the door of 5% at 4.96. Bond traders this week completely erased all expectations for Federal Reserve rate cuts in 2026. Bloomberg reported that the trade suffered a total blowout. Those are their words, not mine. Now, why does this matter for silver and gold? Because when bond yields are rising like this, it means the bond market itself is losing confidence. Investors are demanding higher yields to hold US government debt. They are saying, we do not trust that this debt will be worth what you say it will be worth. That is a crisis of confidence in the very foundation of the US dollar. Drop a comment right now. Are you watching your bond allocation or are you watching your metals? I want to know how you are positioned because what I am about to show you next is going to change the calculus for a lot of people. And here is the part that blew my mind when I was researching this. The financial sector in the United States is quietly breaking down and almost nobody is talking about it. The XLF, that is the financial sector ETF that tracks every major bank in America, broke through its critical support level of $50.90 back in late February. It has underperformed the S&P 500 by roughly 10 percentage points. JP Morgan, Wells Fargo, Capital One, all of them are showing technical deterioration on multi-year momentum structures. Global hedge funds sold financial stocks more aggressively than any other sector in the week ending March 13th. According to Goldman Sachs, the smart money is not just rotating, they are running. Now, why does the weakness in banks matter for precious metals? because it tells you where the next crisis is hiding. Remember 2008? The banks started showing weakness months before the crisis became obvious to everyone. And when it finally broke into the open, what happened? The Federal Reserve panicked. They went to quantitative easing. They printed trillions, and gold, which had a rough October during the initial crash, ripped higher for the next 3 years and ultimately doubled. Silver did even better. This is the playbook. It has happened before, and the setup right now is eerily similar, except this time the numbers are bigger, much bigger. Consider this. Private credit and private equity leveraged up when interest rates were near zero. Some of those 30-year bonds were yielding less than 1%. Now rates are at 3.5 to 3.75%, and bond yields are pushing toward 5%. These positions cannot survive in this environment. They were built for a world of free money that no longer exists. And when those positions begin to unwind, the contagion will spread into the banking sector because the banks are the counterparties. This is not speculation, this is mathematics. If you are finding value in this analysis, do me a favor and hit that like button right now. It takes 1 second and it helps this information reach more people who need to see it. Now let me bring the data wall together on the metals specifically because I know that is why you are here. COMEX registered silver inventory has fallen to approximately 78 to 86 million ounces. That is a decline of more than 31% since October of 2025. The paper to physical leverage ratio stands at 7.1 to 1. That means there are more than 7 paper claims for every single deliverable ounce of silver on the exchange. The coverage ratio is at 14.1%, which is classified as stress territory by market analysts. In February alone, COMEX delivered over 25 million ounces, which was the highest February delivery volume in modern exchange history. And in January before that, 33.45 million ounces were physically withdrawn in just 7 days. That was 26% of registered inventory gone in a single week. Now think about what this means in context. The paper price of silver is crashing, but physical metal is being pulled from the vaults at a record pace. The price is going down and you cannot get the product. Let me say that again so it sinks in. The price is falling and the physical metal is disappearing from the vaults faster than at any point in history. That is not a market functioning normally. That is a magic trick. And the magician is running out of props. Meanwhile, the gold to silver ratio sits at roughly 66 to 1. Historically, that ratio has traded between 15 to 1 and 100 to 1. When silver catches a bid in a real monetary crisis, that ratio compresses violently. If gold stays at 4,500 and the ratio drops to even 40 to 1, silver goes to $112. At 30 to 1, it goes to 150. At the historical monetary ratio of 15 to 1, silver goes to $300 an ounce. Now, I am not saying any of those targets are guaranteed, and this is not financial advice. I am sharing what the data and historical patterns suggest. Every individual needs to assess their own circumstances and risk tolerance, but the mathematical potential here is unlike anything we have seen in our lifetimes. Share this video with one person you know who holds precious metals or who is thinking about it, because what I am about to tell you in the final minutes ties everything together. Here is the big picture. The Federal Reserve is trapped between inflation that is re-accelerating and an economy that is stalling. Bond yields are breaking out to the upside, which means the bond market is pricing in a loss of confidence in US fiscal management. The financial sector is deteriorating technically, which historically precedes major credit events. $44 trillion in foreign-held US assets sit on a foundation of faith in a currency that is being debased at an accelerating rate by any measure of M2 money supply. Oil above $112 a barrel is going to turbocharge inflation in every sector from food to pharmaceuticals to manufacturing, and the war in Iran shows no signs of ending quickly, which means this energy shock is not transitory, it is structural. And through all of this, central banks around the world are accumulating gold at record levels. The big American banks have been forecasting higher gold prices, and in their managed accounts, they have been positioning accordingly. The open interest in the COMEX silver contract is near 20-year lows. The speculative positions have already been flushed out. There is nobody left to shake out. The market is clean. When this turns, and it will turn, it could happen so fast that if you are not already positioned, you will miss it. That is not my opinion. That is what the historical pattern shows us every single time. In 2008, gold had a bad month in October and then ripped higher for 3 more years while the stock market continued to fall. The people who sold their gold during the crash never got back in at a better price. Not once. There are 3 types of people watching this video right now. The first type is scared. They see silver down 44% from the high, and they are wondering if they made a mistake. The second type is confused. They hear the data, but they do not know what to do with it. And the third type understands exactly what is happening. They see the bond market breaking, they see the financial sector cracking, they see the Fed trapped, and they understand that every single one of these forces ultimately leads to one outcome: more money printing, more currency debasement, and higher precious metals prices. Which type are you? Drop it in the comments. Type 1, 2, or 3. If you got value from this video, hit that subscribe button and turn on the notification bell so you never miss an update. Like, comment, and share this with someone who needs to hear the truth about what is really happening in these markets. Every reference cited today is linked in the description below. Thank you for watching. I will see you in the next one.